What's up, guys? I'm Nobody Special, and we have a special guest with us today. I have got my friend Joe Brown from Heresy Financial is joining us, and we are going to talk about liquidity and central banks and debt and interest rates and repos and reverse repos, everything under the sun. Joe, how are we doing today?
Very good. Thanks for having me.
It's my pleasure. Thank you for being here. And if you don't mind, I want to tell a little anecdote real quick because you have been a very big influence on my channel. I think I've told you this in private, but it was September of 2019 when Repo Madness hit. And I was, not nearly as versed. I've always managed my own finances, but I wasn't as in-depth as I am now. And I saw that something had happened in the repo market. I had never even heard of the repo market in September of 2019. And I wasn't getting straight answers on the press. All I knew was unemployment was low. The stock market was at an all-time high. Everything was going well. It was the best economy ever. And suddenly the Fed is printing money and injecting liquidity. Didn't sit right with me. Got no answers. Bloomberg, CNBC, Wall Street Journal, nowhere. So I went to YouTube, and that was actually where I was introduced to finance YouTube. And it was your channel that I found. You had one of your very early videos when you were but a wee lad in YouTube terms, and you were explaining what had happened with the blow up in the repo market. And I was hooked on finance YouTube at that point. And then, of course, throughout the ensuing months and the ridiculousness of this decade, here we are today. And it's fitting almost to the day, 6 years since that we're here talking about liquidity again, because we've had some events suggesting maybe early indicators of stress building up. So let me just kind of hand you an open mic here. Have you watched liquidity and bond market function pretty closely? What do you see out there that has maybe caught your attention recently?
Well, to be honest, everything that is happening right now, and by right now, I mean the last couple of days, is shockingly similar to what happened in September of 2019. The biggest difference, which is actually meaningful, is that Jerome Powell was there during 2019, caused that to happen, had to deal with trying to fix that mistake, and then now this time around has some things that are already in place in order to make sure that something like that doesn't have any large scale consequences like it really could have back in 2019. So in terms of the driving forces, liquidity, government borrowing, spending, that kind of thing, very, very similar to 2019. It seems like the Fed was largely expecting something like this to happen, which is why there's some of these things in place to deal with it preemptively, which we can get into. Things like the standing repo facility are there to deal with it. Some of the driving forces are like the Treasury General account. And so that's kind of what I'm looking at right now in terms of the similarities. The last 6 years have just been, ever since that liquidity shock in 2019, really just a massive explosion of printing, 2020, 2021. And then for a couple of years after that, the Fed was dealing with the consequences of those mistakes, trying to drain all that excess liquidity out of the system. And so they've gotten to a point now where the excess liquidity is gone. So where do we want to go first?
Okay, so a lot of good starting points there. Let me just show some things. Here's the excess liquidity I think that you were referring to, the reverse repo, right? And that is now near zero, not quite zero. And we're looking at 1 year here. Let's look at 5. There's a lot of excess liquidity that they have eliminated. Failed some banks along the way. That was fun. But now here we are at zero.
Right back to where it was prior to 2021. So that's all the excess money printing that the financial system couldn't handle without pushing rates negative. All of that got sucked into the reverse repo facility. And then if you look at when it started to decline, that was mid 2023. Yep. Go to the Fed's balance sheet now.
Okay. That's mortgage-backed securities. Fed balance sheet.
Look at the peak So
Looks like.
it took about a year of them tightening for that to result in the excess liquidity in the system starting to get drained down. So they started to reduce the size of their balance sheet. About 1 year later, that started to pull those excess reserves out of the reverse repo facility.
And then, of course, we talked about failed some banks. There's your bank failures, the bank term funding program. It was not QE once again, and then, of course, resumed our way down. Now here we are down here, and we're kind of leveled off. Let's zoom out a little bit on this chart. We're kind of leveled off a whole hell of a lot higher than we started this endeavor, right? Here's 2019. Here's my introduction to Heresy Financial on YouTube shortly after this little inflection point. Then the vid happens, up we go. We keep printing way too long, and then all that tightening, we're really pretty much just back to where we were in July of 2020 here, only a little bit lower than that.
Yep. And we're not headed any lower. So back in 2016, 2017, they were saying, hey, we're going to keep the balance sheet steady. Eventually, we'll tighten to undo all the printing that happened to deal with the financial crisis. And then with the Tax Cuts and Jobs Act, the Fed looked at that and said, hey, we've got some excess capacity in the economy to do some tightening now that there's this fiscal relief from the tax cuts. So that's when they started draining their balance sheet and raising interest rates. Started crashing the markets. There was no inflation by their measures at that time. And so with all the pressure from the Trump administration, they had to reverse course. They stopped raising interest rates in early 2019, but they kept on tightening their balance sheet. And then the repo market blew up. So the main driver of this at that time was too much liquidity had been sucked out of the system because obviously the Fed was tightening at that time, which tightening is the opposite of QE. So that's literally dollars ceasing to exist because when the Fed prints money to buy assets, that's injecting liquidity, that's quantitative easing. When their balance sheet declines, it's dollars being paid back to them for those maturing assets, and those dollars then exit circulation. They cease to exist. They literally get deleted. And the same exact thing was happening in terms of the effects, the tightening effects on the fiscal side with the government, with the Treasury. So they're borrowing extra money, they're spending money, so they're sucking liquidity out of the system. 2019, all the banks go to each other to say overnight, they say, hey, I've got some collateral, which was treasuries. This is good collateral. Got some collateral. I need some cash. Nobody had any cash. So the repo rate spikes overnight. If they can't get cash, banks collapse because they don't, it just is, it's a pawn shop. So they need to go get cash from each other overnight. They pledge securities to each other to repurchase later. They can't do that. So the Fed then has to start not QE. Even though their balance sheet is expanding, they don't call it QE because the purpose is liquidity. The purpose is not easing.
These were short-term repos, right? So they're supposed to be kind of neutral because in a few days we close them out and the money disappears. But they kept doing it and getting bigger and bigger. So there was a cumulative addition to the balance sheet, right?
Yeah. And I think they were mainly buying T-bills at that time. And so that was the other thing. They're saying that it's short term. It's not long-term treasuries that we're buying here. So the only thing here is to grease the system for liquidity. Really just undoing all the tightening that they had done since 2018. Right. So obviously that wasn't enough. There were a lot of problems there. It was a gift for them that they were able to print a couple $1 trillion a couple months later. But obviously they overdid that and the financial system couldn't handle all that liquidity. That's where then the overflow bucket was the reverse repo facility. And so now we've been doing the same, that they've been doing the same thing that they were doing in like 2017, 2018, 2019, which is trying to undo all the excess easing from the last crisis through tightening, draining excess reserves out of the system. And just at their last meeting, they announced, okay, this is the end. As of December 1st, we will not be allowing our balance sheet to decline anymore. We will keep it at roughly $6.5 trillion. Now, the interesting thing is, this wasn't, I don't know if he talked about it because I didn't watch the actual press release with all the questions, but it was in the implementation notes for this recent policy change. Yes, they are keeping the balance sheet the same size, but they are going to be still letting the mortgage-backed securities roll off, and they're going to be replacing that on the balance sheet with T-bills.
Yeah,
so,
and I tell you, you could watch the home builders. They started selling off on a dime when he made that announcement during the press conference. The real estate market did not like that. So what we're looking at here, Joe, is the Fed's balance sheet, their holdings of mortgage-backed securities, mortgage bonds. Now, they've been unwinding these at a pretty steady clip. And so, like you said, they're going to continue unwinding these, which means they're going to continue letting them mature and get paid back, but they're not going to be destroying the money. They're going to keep the balance sheet neutral. So where's that money going to go instead?
Going to the government. So they're going to be buying T-bills with it. T-bills is the main driver of well, not the main driver, but a main driver of deficits right now, fixing or improving the deficit, because Bessent has been rolling basically everything over into T-bills, because as the Fed lowers rates, that's going to have the most impact on T-bill rates because it's short term. And so they don't want to borrow at the long end of the curve while it's difficult to borrow and auctions are not going well and interest rates are higher. They're rolling it all over with T-bills, just constantly rolling it over, maturing, because it's lower rates right now. And then once the long-term rates do come down, it'll all be liquid and they can roll that all over into long-term when and if they need. And so as the Fed lowers rates and pushes T-bill rates lower, that means that the total interest expense on the debt immediately gets lowered. So it's been over $1 trillion for a couple of years now. And if T-bill rates get low enough, that could, that could significantly decrease the amount that the U.S. government is spending on the interest on the debt. And it's also the thing that has the most demand from the financial system, because it is the most liquid. There is the least amount of interest rate risk, inflation risk. So it's just kind of, the savings account for major institutions. So there's almost unlimited demand for T-bills around the financial system. And so the Federal Reserve is just adding to that fire there by using the money they get from the mortgage-backed securities to buy T-bills, help push those rates even lower, closer to, even lower. So greasing the system for liquidity again, just like they were doing in 2019. It's just a little bit ahead of time. They're not waiting for that repo market spike, even though we've started to see some of that come in.
We have. And there's something else Powell said right around the time he was making that announcement about the Treasury bills instead of the MBS, which means he's robbing Peter to pay Paul as far as the balance sheet is concerned, right? He's taking money out of the housing market, putting it into the T-bill market. He said they had seen some signs of stress in money markets or something to that effect, he had said during the interview. And that's the first I had heard. I don't know what he saw that was telling him that. But when I see him talking about effectively QE, not QE for T-bills, and then talking about stress in money markets, I couldn't help but think about the gilt crisis in the UK in 2020. Was it 22 or 23? I know there was a lot of trouble with the basis trade with liability-driven investment schemes and pensions, which are basically interest rate swaps. And I know the basis trade has always been a big vulnerability, people picking up pennies in front of the steamroller. So have you seen anything that might explain Powell's comments about trouble in money markets?
I think he was talking about the increased usage of the repo facility. Because when there's low liquidity in the system, that's where trouble pops up. That's what triggered the financial crisis and Lehman fell over and everybody was about to collapse. That's what everybody was scared about in 2019. And so with the reverse repo facility hitting zero, that means we no longer have abundant reserves. And so in the Fed's like classification of the financial system with reserves, anything, well, it's percentage based, but in our dollar terms here, like we were at like the banks had like $5 trillion worth of reserves. It was 3 trillion of like actual bank reserves and about 2 trillion in the reverse repo facility. And the Fed says all that together counts as reserves because it's basically fungible. And so that they called that abundant reserves. And it's like 15% ish was kind of the percentage there. Now with the reverse repo facility gone, the bank reserves are at basically 3 trillion now. That's like it's in the 10 to 12% range, and they call that ample reserves. But this is the chart that you have up is the regular the usage of their standing repo facility. And their standing repo facility did not exist prior to 2021. And so if they were going to intervene in the repo market prior to 2021, like if you hit the max button there on the chart to zoom all the way out, then you'll see they did intervene in the repo market before. They used to do it quite a bit. And then after the financial crisis, they stopped. And then, because they didn't need to because there were no liquidity issues. And then suddenly in 2019, all those liquidity issues came roaring back. So they intervened there, but that was they had to make a conscious decision to go in there and start adding to their balance sheet that way. But if you zoom in now on just what's been happening over the last, the big gap there between 2020 and right now, obviously there was again, excess reserves in the system. So there's no need for the Fed to intervene in the repo market in this way. And then zooming in on just what's been taking place over the last couple of months, like the last year there, you can see, okay, now they're intervening again. The difference this time is that ever since 2021, they established this as a standing repo facility. So now they don't have to go in and like make the conscious decision on how much or are they going to. Anytime there are liquidity issues, if that overnight rate gets to a point where banks are like, nope, that's too much, I don't want to pay that to get the cash I need, they're just going to turn to the Fed and get everything that they need there. And so I believe this is what the Fed what Powell was referring to when he said trouble in money markets, is that, hey, liquidity is getting to a point where we're no longer in excess territory and banks are tapping us for that liquidity. And so we have to put an end to QT now. We have to start adding to the T-bill market to keep that machine greased. And so I believe this is what he was referring to.
So I want to draw your attention to Halloween here. Friday, October 31st.
Yeah.
Almost $30 billion from the standing repo facility.
Most of that is window dressing.
I'm sorry?
Most of that is window dressing. At the end of quarter, financial institutions need to make their balance sheets look super squeaky clean. And
end of the month spike.
Yeah. You see it. You see quarter end and especially year end, but you see quarter end spikes like that a lot.
Now, October 31st, not a quarter end, right? It's a month end. But yeah. But the point is well made. It did happen right on the month. Now, something else that was interesting, and of course we were leading up to it, right? Because you can see the frequency is increasing of its usage. Now it's a daily occurrence. We've gone from a flat line and a blip back to a flat line to now there's some brain activity. The patient is alive here. Something else I wanted to point out, and I talked about this quite a bit on my live stream yesterday, was SOFR, the standard overnight financing rate. And this is the rate to charge for loans between banks, big loans overnight in between banks. Now, this chart, I just want to point out, when the Fed cuts, you can expect a step change down like we got here in September when they cut, and like we got last week on Wednesday when the most recent cut happened. But right around the 31st, again, when that window dressing happened, we saw SOFR go from 4.04 to 4.22. Almost negating the entirety of the Fed cut. Now, we've come back down, but we're still pretty elevated here at 4.13. And there's a chart that visualizes this a little bit better This is SOFR minus IORB or IORB. This is the interbank rate, SOFR, minus what the Fed pays on overnight reserves parked at the Fed. And so watching this spread between the two, now you can kind of see since August, it's been rising. And then, of course, it made that spike, the window dressing, as you said, at the end of the month. But that spread is still very much elevated, and it appears to be growing. So you already kind of half answered the question with the window dressing comments, but is there anything to be concerned about watching this spread grow and watching these overnight rates start to tick up just as the repo usage is getting used more frequently?
In terms of like trouble in the financial system, I don't think there's anything concerning because any of all these liquidity issues that are like this is a sign of strained liquidity in the system. These rates rising and staying elevated. The Fed has even Powell, like I said, he was at the Fed in 2019 when this all happened. That's why they established the standing repo facility so that when liquidity got to be an issue again, it would be ready to go for any amount necessary. The reason, though, why this is staying elevated, and it's not just the month end, it's not just a single day going back to normal, is because the government shut down right now. So do you have the Treasury General account chart?
I do. Stand by.
So we have all that tightening that's been happening from the Fed for the last 2.5 years. And they were getting to a point where they're like, all right, now reserves are down to a point where it's no longer abundant. It's just ample right now. We're good to go. And then suddenly the government shuts down, but it's not a debt ceiling shutdown, because in a debt ceiling shutdown, on the Treasury General account, do the time frame, do like 10-year. So you can see these big dips like in end of 2021 and then mid 2023. Those are like the debt ceiling shutdowns where the government can't borrow and they have to spend all of their money, because the Treasury General account is the checking account for the U.S. government. So anytime they take money from us in taxes or borrow money, it goes into this account. Then anytime they spend any money, it goes out of this account. So when the debt ceiling issues happen and the government shuts down, they can't borrow. And so this account just gets drained because the only money they can spend is money they already have in their checking account, which comes from here. And so this account gets, dangerously low every time. Right before they default on their debt, the Congress suddenly is like, all right, we have a deal. And so that's why that's happened that way before. But what we're seeing right now is a government shutdown over budget issues. They're just disagreeing on how to spend the discretionary portion of the budget, which means since it's not a debt ceiling issue, the government can continue to borrow. They're continuing to tax, but they just can't spend as much as they always spend because a bunch of people they're not sending out their paychecks and everything from the parts of the government that are shut down. No SNAP benefits and all that. And so instead of the checking account going down, the checking account shoots up because they're bringing in way more money than they're spending right now. And so they like to keep this account around $850 billion because that's around like 5 days of outflows when you consider all the T-bill rollovers and all their money they spend. If they, had to just spend from here and they weren't taking anything else in. But now it's just shooting up way past that. And that will likely continue the longer the shutdown lasts. And so this happened right as the tightening cycle ended and the Fed was like, all right, now liquidity is down to a normal level. Suddenly the government's like, all right, well, we're going to just start sucking cash out of the system and not put any back in. And so it's like short term, like a ton of extra tightening happening right now. This is all dollars leaving the financial system. Anything in the TGA is not in the financial system. It's a separate account held at the Fed. So it's that's driving a lot of the extra tightening that's going on right now too, and the shortages in liquidity around the financial system. Wow. Is this government shutdown, which will all be reversed when the shutdown ends, and there will be a flood of liquidity back into the system. But for right now, it is causing things to get tight.
So the shutdown is actually a liquidity drain because we're collecting taxes, we're collecting fees, but nothing is going out being spent back into the economy. That had never occurred to me.
Yeah.
Wild. Wow. All right. So 2020's bingo. Who had a government shutdown triggering a liquidity crisis on their 2020's bingo card? That's one I did not expect. Nobody expects that one. All right. So we got a pretty good picture of what's going on with liquidity in the market right now. There's something else I wanted to bring up and we touched on it earlier. We talked about the mortgage-backed securities rolling off the balance sheet. So
Yeah.
obviously we're now pulling money out of the housing market and then putting it into the treasury in T-bills. What does that mean for your Gen Z or for your millennial who's sitting here wondering when the hell will I be able to afford a house? What's that mean for him?
Yeah. I'm not sure the extent of the influence that the Fed has on the overall housing market from their holdings of mortgage-backed securities. It is not negligible. It's definitely not the main driving force. But all else being equal, yeah, when a big holder of mortgage-backed securities is selling those mortgage-backed securities, that is price down, and for bonds, that means rates up. So that doesn't mean that that is the exact net result. It just means that all else being equal, that would be the net result. And so there are other driving forces that can overcome that, but it's still rates higher than they would be otherwise. Now, you also have to say, okay, well, the Fed bought those mortgage-backed securities in the first place, which means those rates were lower than they would have been otherwise, which is also true. But yeah, right now it is a force that is pushing up on mortgage rates. Now, I think there is a pretty good chance that since that's what's happening from the monetary policy side of things, I think just given everything this administration has done so far, I think there's a very good chance that administration tries to intervene in mortgage markets and just say, all right, mortgages are 4% now. Like, no, but I would not be surprised to have the something crazy where it's like, yeah, we're taking stakes in these companies. Sure, why not? Like, the government owns 10% of this public company now. Mortgage rates people say are too high. All right, mortgage rates are 4% now. Like, who knows if it would actually, what the implications that would be, or if it would be held up. But I given the amount of how unaffordable housing is, I would not be surprised to see that be an issue that the administration tries to handle by just declaration and force. So the other factors that are at play in the housing market are also obviously supply and demand. So a lot of people are pointing at this is a little bit of a bunny trail, but people are talking about boomers not just giving up their homes for millennials, and it's like, what a dangerous communist Marxist ideology to say, okay, somebody old has something I want, they should give it up. It's like that is just dangerous. Immoral rhetoric. It belongs to them. So anyway, there's that. There's the demographics there, and eventually, time comes, and the results of time, and hit everybody, and eventually that housing will hit supply. Anyway, but the other big thing is immigration right now, and a lot of people think that if you just deport everybody, then there will be enough housing supply, and it's like, well, that's not the reason why we have a housing shortage. We have a housing shortage because we have zoning laws and building codes and federal a regulatory framework that makes it virtually impossible to build affordable housing. The only housing that's been built in the last 15 years is, McMansions, because it's the only way you can build an affordable house or a profitable house as a builder. And so we don't have supply for 15 years, keeping up with the population increase. And that's the driving factor. And it's like the deportations that are happening right now are nowhere even close enough to make a dent on that supply demand mismatch. And even if it did, that's going to happen in low income multi-housing only. It's not going to touch single family where millennials want to buy in the center of cities, big metropolitan areas. And so it's a matter of building, laws restricting building, and that it has not kept up with the population and the people who want a place to live. And then anytime there's a problem with it, it's just like, all right, well, let's try and make the payments cheaper by lowering interest rate, which artificially increases prices. So it's a problem that I don't think will be solved anytime soon. none of the solutions that are politically palatable are good long-term solutions. They're only short-term solutions that make the problem worse long-term. So long-winded answer to say, I don't think we have any sort of setup nationwide for any sort of a big decrease in home prices. And in fact, any decrease in home prices that have happened in specific local areas over the last 3 years, I think are probably near or at the bottom. And we're close to that trend reversing again.
Now you touched on immigration there, and that actually is a segue to the last topic I wanted to talk about with you, and that is the cockroaches. To quote Jamie Dimon recently, started with Tricolor going bankrupt, and immigration and deportations absolutely played a role in that one. Tricolor derived its name from the Mexican flag, the 3 colors of the Mexican flag. They specialized in loans to underserved communities, people without social security numbers. Primalend was another subprime auto broker that has gone bankrupt. No indications of fraud there. And then more recently, there was another name in the press. First Help is a subprime auto lender, also specializing in people without social security numbers. So we have seen the crackdown on immigration has caused stress in subprime auto. And it's reasonable to assume that's going to probably filter into the ABS market one way or another. We've also seen some other problems with factoring companies like First Brands, and then Carriox Capital, the telecoms company, another cockroach that went bankrupt due to a lot of fraud with receivables. Do you think these early indicators of stress in the financial system that we've seen, and then the sudden emergence of these cockroaches scurrying, are these two related? Are we seeing one because of the other, or vice versa? Could one cause the other, or is this just it just happened this way?
For the most part, fraud, it's a timing thing. Most of the time it gets, if it's going to be revealed through some sort of monetary or fiscal policy, it's because of tightening and raising interest rates, not the opposite. And we're moving into, yes, short term, we do have the liquidity things right now, but on a broader scale, what we're seeing right now is we're moving into an easing monetary environment. We've got QT coming to an end. We've got more of that money going into T-bills. We've got fiscal deficits that just won't stop. QE is going to have to restart again to monetize that. We've got interest rates going down. So you're in an environment where anybody participating in any of this lending fraud, that you're able to kind of cover it up and get away with it. It's when things get going the opposite direction that that kind of stuff gets revealed. Over a long enough time period, though, it doesn't matter. It always comes out and it always gets revealed. So the first question, I don't think the short-term liquidity issues right now have much to do with. I think Tricolor, the bankruptcy announcement was early September.
Middle of September, yep.
Middle of September. So, and I think that was before the government shutdown started. Yes. So yeah, I'm not sure that those are connected. However, this whole space is something that for like quite a few years now has just been growing and growing and growing. It's like it's only a matter of time before this, just like mortgage-backed securities, back in 2004, people were talking about it. 2005, people were talking about it. Like I think Ron Paul was talking about it in like 2003. And there's some other very big players doing very similar stuff too, like Carvana. Like I don't know if you've done a deep dive into Carvana yet on your channel. If not, I would love to see it.
We need to bring this out. Do we put that on now?
Yeah. The amount of billions of dollars of insider selling by the dude's dad of the Carvana shares in order to fund a separate company to buy out all the bad loans from Carvana. It's just like Uh,
They're selling. Yes, you spun me up a little bit. They're selling warranties and maintenance contracts with their vehicles, booking all the revenue up front, and then immediately moving the liabilities onto Drive Time's balance sheet. So, I mean, a warranty is essentially, it functions like an insurance contract. You have an asset and a liability. They take the asset, they report that all at once as revenue, and then the liability lives on somebody on dad's balance sheet. Must be nice. Yeah. And then I'm hearing all kinds of anecdotes since I started talking about Carvana. People are telling me that Drive Time is not honoring any of these warranties. They're not doing the work they're agreeing to. Carvana is a ticking time bomb. I don't know how much time is on that clock, but oh yeah, brother.
Full disclosure, I've been short Carvana through the use of put options for quite some time now, and so far time has not been on my side. But yeah, so I there's a lot of this in the industry right now, and I think it's only a matter of time before it all fully blows up. Even other like the pay as you go loans. I know it's not car related, but like Affirm has a lot of problems right now. I think they just signed a deal with DoorDash where people can basically pay, pay for their burrito delivery over, the course of the next couple of months because they can't afford it right now. It's like, maybe you shouldn't be using DoorDash if you have to
finance somebody else to bring me my McDonald's and then pay for it over 4 easy low interest payments. It's like just a perfect microcosm of everything wrong with us right now, isn't it?
Yeah.
Oh. Yeah, and I've been highly suspicious of Affirm also because they've been reporting consistently low delinquencies, 2.4% delinquencies on non-recourse debt. There's nothing to repossess. They rubber stamp the loans. The average borrower has a subprime credit score. All the while, student loan delinquencies, credit card delinquencies, everything is rising, but everybody's paying their Affirm loans. That doesn't sound right to me. And
yeah.
I can just tell you, Max Levkin, the CEO of that company, his body language, I'll clean him out at the poker table. Let's just put it that way. He's a terrible liar. Absolutely terrible liar. So it's interesting you should name those names because they are companies that I think we both arrived there through different courses, but we got there.
Yeah.
All right. So if I could summarize the answer to that, the fraud has built up. You don't think it's related to the short-term funding stress or liquidity. It just so happens to be at such a saturation now that it's bound to start being exposed. And then now I'll ad-lib a little bit on top of yours. Once they find one and they find two, then everybody else goes start looking in their books and starts being a little bit more scrutinizing, and you find more is what I think is probably playing out now.
Yeah. That all the easing in 2020 and 2021, it, and anytime it happens, it's what fuels Ponzi schemes. It's what fuels frauds. It's what fuels, I'm pretty sure all the biggest Ponzi schemes throughout history have always happened on the backs of monetary easing, going back even to Charles Ponzi. I could be wrong about that, but it's a ripe environment because essentially you get a bunch of money that's just looking for any return possible. And the better the return, the more eager that money is to go flood in there. And so it's just a perfect environment for fraudsters to take advantage of. And then, it eventually all gets revealed. I think it just takes a lot longer than most people would like.
Yeah, chasing yield rarely works out well for people because they move out on the risk for an increasingly shrinking reward.
Yeah.
Well, Joe, I really appreciate you taking the time to talk to us again and offer your insights as always. It's funny, we're talking about this like almost to the day 6 years after I first discovered your channel. So having a little bit of ancient history nostalgia, if you will. I'll give you the last word. Anything else you're keeping an eye on or you think that people should be alert to?
I think the balance sheet composition is a big one. The Fed announces these moves ahead of time, but anything that happens that's like surprise, it's always a big thing to pay attention to. in terms of investing, I would just like to caution anybody that just because you see valuations at a historically extreme level does not mean anything by itself. When you look at valuations of asset prices in places that go through like hyperinflation, like Weimar Republic in Germany and Venezuela, it's like debasement justifies higher valuations. And that's why everybody, when you have a fiat currency and you're, in this kind of a cycle of a fiat currency, everybody has to kind of turn into at least a part-time professional investor. Otherwise, your wealth will kind of evaporate on you. So you have to be invested in assets, do it judiciously, buy good assets, hedge, employ strategies to make sure that you are, not just throwing money on a poker table, but otherwise you're just going to give it to the government through inflation.
I can't tell if you're talking about gold or if you're talking about Palantir when you're talking about these valuations, and don't get too hung up on them. I don't know. You're going to get a different response out of me depending on which it is. But
right.
The valuation of everything is through the roof, and we looked at all those charts with all the new money. Makes sense.
Yep.
All right, folks, that's Joe Brown from Heresy Financial. Hey, I'm going to put a link to Joe's website, to his YouTube channel, to his Twitter feed down in the description below. He is one of the best, in my opinion, largely the inspiration for this channel. So thanks again for that, Joe. Always appreciate your time. Everybody else, till next time, live small and dream big.
Thank you.